Hi folks, welcome back to Moti Finance Academy. Let us start. Today we're going to peel back the layers on CreditAccess Grameen's recent performance. We're going to move way beyond the headline numbers to really understand the massive shock that hit not just the company but the entire microfinance industry and figure out what the path to recovery actually looks like.
So here's how we're going to break this down. First, we need to understand the industry-wide credit shock. Then, we'll deconstruct the company's cleanup job. After that, we'll dive into the margin story, look for signals from management, and maybe, most importantly, pinpoint what the market might be missing. We'll wrap it all up with a framework you can use to track what happens next. All right, first up, let's get our heads around this industry credit shock. Was this a problem CreditAccess Grameen created for itself, or were they caught in a much bigger storm? So, the first question any analyst has to ask is this: were the company's problems self-inflicted, or was this just a symptom of a much wider issue?
Well, the evidence points pretty clearly to an industry-wide problem. The big trigger was a set of new regulations, these MFIN guardrails and what's called a three-lender cap, which basically changed the rules of the game for everyone in the lending space.
Yeah, these new rules, especially that cap on how many lenders one person can borrow from, created a huge structural shock. And you can see how this played out right here. In Q1, the new cap caused major disruptions. By Q2, delinquencies were spiking as credit got tighter across the board. And now in Q3, we're just starting to see things calm down and normalize a bit.
Okay, so we've got a handle on the problem. Now let's dig into the mechanics of the cleanup and what it really tells us about the health of their loan book.
So the company's big response was this massive write-off. We're talking almost 1,300 crores. Management called it an accelerated write-off. But here's the real question for us. Was this just some proactive housekeeping, or was it them admitting that the risk across their entire portfolio has fundamentally changed?
And this slide, this is where it gets really interesting. Management's narrative is that they chose to do this early, but the economic reality, this was a forced move. It was a necessary response to a permanent structural increase in portfolio risk. The whole game changed because of those regulations. Now, if you look at the breakdown here, it's pretty stark. In both Q1 and Q2, almost all of the write-offs were in that so-called accelerated bucket. Management says this part will shrink, but what we need to watch like a hawk is the normal component. That 126 crore number in Q2, that might be our first real clue about the new, higher baseline for their credit costs going forward.
All right, let's see how this whole cleanup saga feeds into the company's margin story. Because while these huge credit costs are a massive headwind, there are actually some powerful and maybe overlooked tailwinds helping them out.
You know, despite all that turmoil, their core earning power, what we call net interest income, it's still pretty robust. That's thanks to AUM growth. But the real drama is happening on the cost side of the equation. So, here's the crucial point. The business is getting a boost from two really strong tailwinds. Their cost of borrowing is going down, and the yield on their portfolio is going up. This is helping to cushion the blow from those sky-high credit costs. The big question for profitability is, are these tailwinds strong enough to overcome the new, higher run rate of write-offs? Now, let's step away from the P&L for a moment. What management is doing with its capital and the subtle shifts in their focus can give us some critical clues about their strategy for the future. So publicly, the tone is all confidence. They're focused on hitting those big growth targets. But are their operational metrics telling us the same story? And right here, this is what I'd call a hidden signal. While they're publicly guiding for asset growth, look at this key operational metric, borrowers per loan officer. It's going down. To me, that suggests a quiet, defensive shift. They're prioritizing better underwriting and service quality, even if it means sacrificing some short-term efficiency. Okay, this brings us to what I think is the most important part of this whole analysis, identifying the signals that the market might not be fully pricing in yet.
This is absolutely critical to understand, and it all comes down to a simple, mechanical lag in their accounting. See, their policy is to write off bad loans after 9 months. What that means is the real pain from that big delinquency spike back in Q1, it hasn't even fully hit their income statement yet. The cleanup isn't over. A big chunk of those bad loans will only get formally written off in the upcoming Q4 results.
And that brings us to the key risk, right? If the market sees the recent improvement and assumes a smooth recovery from here on out, it might be seriously underestimating the final write-off number that's still coming down the pike in Q4.
So to move from just analyzing this to actively tracking it, we need a clear framework. We need to know exactly which leading indicators to watch in the coming quarters.
And here it is. Think of this as our dashboard for tracking the recovery. We're going to be watching that Q4 write-off number like a hawk to see if it matches what management guided. We also need to see their provisioning stabilize and that normal credit costs start trending back down next year. These are the signals that will either confirm the recovery story or tell us it's broken.
Which leaves us with this final and maybe most important question. The cleanup is happening, yes, but has the underlying risk profile for the entire microfinance business structurally changed for good? CreditAccess Grameen is navigating this cycle, sure, but the whole sector might be settling into a completely new normal of higher credit costs and much more cautious growth. And that is the key strategic question to think about. Thanks for tuning in. If you liked the video, please like, share, and subscribe.